Well, thank you for joining the National Real Estate Cafe. For over 2 years now, we've been sharing with you some great information about what's really happening in the real estate and the financial world, because we don't have any hidden agendas. All we're doing is giving you the real truth and some great information that you need to know.
So today we're going to give you a little bit of education. We're going to talk about the number one reason that clients get declined today. It's not for credit, and it's not for lack of assets or down payment either. It's debt to income ratio is the number one reason people don't qualify for a loan.
Yeah, so let's go to the first slide. So it's DTI is what you're going to hear. It's another acronym. We have 6,000 of them in our industry. So the DTI, debt to income ratio, is one of the number one things that all lenders look at. It's required by law now that we look at your debt to income rate, your ability to repay your mortgage.
That's right. So we need to, you can no longer lend on cash alone, on down payment alone. So a lot of times we'll hear, but I'm putting 50% down. What do you mean I don't qualify? Well, you can't just qualify based on assets anymore. They've changed those rules. So not only equity, not only assets, you must show the ability to repay. So here's some calculations of how we get the debt to income.
Well, and just to clarify one more time, we ran into that problem because there were a lot of loan programs out there that was not based on your ability to repay. It was based on the equity position. Well, when that equity position went away, we had a lot of problems nationally and actually worldwide. Because a lot of people purchase those loans based on the feeling that you could repay, but there was no equity position.
So let's talk about this, right? So the traditional lender used to believe that if you had 25% equity, right, or 20 or 25 or 30% equity, that's how they protected themselves. If they were to foreclose against you, they could sell the property and not take a loss. Well, in the world of mortgage insurance, in the world of FHA loans, VA loans, all these loans with low down payment, that changed a little bit. So the bank doesn't have as much protection. So what they should do if they're doing their due diligence is protect themselves by knowing that you have a renewable source of income every single month so that you can debt service your property.
Debt service, i.e. debt to income ratio. So here we are. How do we calculate those? So basically it's your overall debt, your monthly debt load, which includes your mortgage payment and any other debts you have. We're talking any. Remember, a lot of times you'll think, oh, it's just my credit card debt or my car debt. But no, if you have child support or spousal support or IRS liens or anything else, those get calculated in. So
notice it says monthly recurring debts. So the big word there is recurring. Anything that you pay on a monthly basis that's going to recur affects your monthly cash flow when you get your pay. So the first element is always your income. The second element is recurring debts. And, of course, if you're trying to buy a house or qualify for a house, you got to look at the housing payment.
And that housing payment's PITI,
HOA.
MI. It's got everything that's included in your housing payment, which could be property taxes, insurance, could be Mello-Roos, could be
Solar.
HOA, solar, all that stuff gets calculated into it. So the first one, just give you an easy way how that calculated. If you had a $6,000 income, we'll say Social Security, we can gross it up 125% because it's not taxed. In some cases, not all. It depends on where other incomes are and so forth. But let's just say it's $6,000. Your recurring debt's $500, housing payment $1,500, $1,000. So total cost out of your pocket monthly is $1,500, which is 25% of $6,000.
Yep. Simple enough, right? So the other one, you take the calculation number 2, you take the recurring debts plus the housing payment, that's $4,000 into the $10,000 worth of income. That's 40% DTI.
You kind of get the idea. So in most cases, we can go up to, with conventional financing, 45% debt to income ratio.
Now, both Fannie Mae and Freddie Mac have allowances up to 50 if the rest of your profile is strong. Let's say you have a lot of assets and reserves. Let's say you have a fantastic FICO score, or you do have that equity. They might allow you to go to 50.
All right, and then FHA will allow you to go up as high as possibly 57, 58 even. Not
every day.
Not what we try to push for, because we don't want you basically house poor, but we can push the limits on an FHA.
Well, there's always good reasons to do such as if there's another income in the household that we're not using, or you're about to get a raise but you don't have it yet, or other reasons to push the envelope.
All right. So hopefully this gives you a good idea of what lenders look at when determining what you qualify for. This is how we determine how big or how expensive of a home you can afford, based on your ability to repay.
There's an asterisk here. For you self-employed borrowers, we use the net number for income, not the gross number for income. Just some food for thought when you do your taxes.
All right, you heard right here in the National Real Estate Cafe. Get these sent right to your phone by texting NREC to number 58885 or
check us out at donandgino.com.